Good morning, Southeast Missouri, and wherever you may be listening. This is the Retirement Playbook brought to you by Innovative Financial Solutions. We are the retirement people, and we're here with you every Saturday morning, giving you some great information and some tips to help you get to and through your own retirement. And as always, I'm joined by my co-host, Mr. Tony Shore. Good morning, Tony.
Well, good morning, Brock Alspaugh. Great to be here as always. I'm redlining the fun meter. You know that. Having a great day. I celebrated this past weekend. My two daughters each had a birthday, one on the 3rd and one on the 5th of November. So
Gotcha.
my oldest
Okay.
daughter turned 21, so that's exciting.
Whew, that means
Yeah.
you're old, buddy. You are.
You know what all that means
Getting
is
up
I'm
there.
old. So that's what you took from all that, is that I'm old? Good.
Well, listen, folks, we've got a great show lined up for you today, and we're going to bring some good information. But before we talk about that, a couple things. One, go to our website. It is loaded with great information to help you in your retirement. Look, the best thing you can do is to get a customized goal and plan and how, where you're going and how you're going to get there. But to get started and to get some great information, again, go to our website. It's theinnovativeteam.com, theinnovativeteam.com. You can download past shows by topic. You can download the Retirement Income Toolkit, as well as the Roth Conversion Guide. We're coming up to the end of the year here. You may have not maximized a certain tax bracket that you are targeting. There's still time. You can get this Roth conversion done this year. For example, maybe to maximize the 12% tax bracket. So again, these are conversations we're having all year long, and you still have time before the end of the year to get that done. So download that toolkit, and ultimately, if you need help with that or anything else on that website, give us a call at Innovative Financial Solutions, 573-332-7855. All right, Tony, second thing. I said there's two things. There's second thing, right?
Okay.
In Missouri, we are getting down to the nitty-gritty here with high school football. So we're recording this before Saturday, but I just want to say I hope everybody won last night. Cape Central is playing Farmington. Jackson is playing at Seckman. Two big games. So good luck, everybody. I hope you won. All right, Tony, you ready to get started with today's show?
I am so ready. It hurts at this point. I'm excited. I can't wait to
I
talk
love your
about
energy
this.
today, by the
Well,
way. I love it.
What is your tax plan?
That's the question everybody has, and this is the time of year to be asking it, right?
It is, and actually that's the title of our show today. It's Year-End Tax and Strategy Steps to Take. Again, we're coming down to the wire here, folks, and if there's some things you could do to help yourself, why wouldn't you do that from a tax perspective?
Right.
We talked about, coming out at the end of the year for Roth conversions. Many custodians are putting like the 1st of December on this as a deadline to get things done, like doing a Roth conversion. So, they're as busy as everybody else is. And so if you're going to do it, let's get going on it and take care of that as soon as possible. But as I said, we're coming down here at the end of the year. There's some very valuable tax and financial strategy steps that you could take right now to help you not only this year, but going forward. I mean, that's kind of the Roth conversion story, right? Hey, if we can maximize a lower tax bracket now and then take it out in retirement tax-free when we're potentially even in higher rates because they're going to raise, why wouldn't you do that?
Yeah, that's true. And you want to take advantage of things and make sure that you're not paying too much and you know how capital gains work. And I wouldn't want to go through any of this, though, Brock, without working with somebody like yourself, a financial services professional.
Tony, obviously we're doing this show to bring information and to help people. And if they ultimately want to come see us and ultimately need our help, great. Okay. But the purpose of this show is to give you these insights and give you this information that can help you in your financial life. And so let's move on here. 5 tax moves retirees should consider before December 31st. This is an article that appeared in Kiplinger that we'll just kind of highlight some of the things that they're talking about in this article. And again, the first one actually is Roth conversions, and we've kind of already hit on that, right? Great time of the year to look at, okay, you pretty much know what your income is going to be for the year. So this is
Right.
harder to do, especially like if you're a business owner and you don't know exactly what your income is going to be, right? I mean, that's sometimes a very difficult thing to do. If you're not, though, let's say you're not a commission employee and don't own your own business and you just got a steady paycheck, it's easier to kind of plan for this throughout the year. But for people that their income is variable, this is pretty much, I mean, you know where you're going to be now. It's November, almost the middle of November. So if you know where you're going to be, then do some planning. Maximize those 12s, those 22s and 24 tax rates, and consider doing the Roth conversion. We, Tony, at Innovative Financial Solutions, again, we're the retirement people. This is what we do. We will do the analysis for you. So if you think you're close and you think this might be a good idea, don't just rely on what I'm saying here. Let's get the facts. Let's get the numbers, because numbers don't lie. So if we know where you're going to be at from an income standpoint, give that information to us. We have a Roth conversion analysis that we can do for you that will look at your income, look at your current tax rate, and then project out what rates will be. We know in 2026 the rates are going to go up, right? From the 2017 Jobs and Tax Code Act that was passed, we've had lower income rates, and they're scheduled to go up in 2026. Not only that, Tony, but I think we have 35 trillion now reasons why we think taxes might go up.
It's insane, isn't it? I mean,
I laugh, and it's not funny at all. I mean,
no. Well, you're either laugh or cry at this point.
I've done both.
Yeah. Yeah. When I see the deficit numbers, I do both. And our government's ability or inability to cut spending, taxes are going to have to go up, because they never cut spending. It only goes up. And that deficit is going up. They've kicked the can down the road as far as they can, they say.
So, when you're working and you have all these different wages, we're going to analyze, especially if you're close to retirement. If you're within 5 years, this becomes very easy to do, because we can kind of closely predict what your income and your expenses will be in retirement. So if we're looking at Social Security, if we're looking at required minimum distributions, for example, if you're of that age, and basically the required minimum distribution, Tony, is once you reach, right now, currently, it is age 73. If you have IRA monies that you've, really have not touched because you don't want to pay taxes on those withdrawals, at 73, you have to. So the government says you have deferred the taxes long enough, you have to take out a certain amount. Okay. So again, that's kind of another end of the year thing is to make sure, guys and gals, that we're taking the required minimum distribution that you have to. There's big penalties if you don't do it. So again, you've got until December 31st. The earlier, the better. We're still finalizing some of ours for our clients, and that's okay. But we definitely don't want to run the risk of it not getting completed by December 31st. So that is something that I would highly recommend that you go ahead and take care of now. The planning that can go around the required minimum distributions. So we just talked about Roth conversions, Tony. Now, again, some people listening to this might go, well, you're talking first world problems here, right? We're planning to not have to take money out of our accounts. And I, excuse me, I get that. But it becomes a serious problem because when you have to take a large required minimum distribution from your accounts, it causes your other income to be taxed at higher rates too. So again, for some people, this doesn't apply at all. But there is some required minimum distribution planning you can do that involves Roth conversions, right? Because when that money gets out of the IRA and gets put into a Roth IRA, you pay the taxes on it at that point. But then it grows tax-free. And the other benefit of doing the Roth conversion, Tony, is that you do not have a required minimum distribution from that account. So, and if you did, it's tax-free anyway because it's a Roth distribution. So this can really help. I just had a scenario this week. Okay, let me give you an example. I had a client. They've been a long-time client, really good client of ours. And so his parents, there's 3 siblings, passed away. Okay, and they got a big inheritance. Well, we had planned on the distributions coming out of their retirement accounts. Well, now, because of this inheritance and this after-tax money that they're looking at, and thank goodness we have a step up in basis for a lot of this, so not a lot of taxes due on this inheritance. But the point is that now that they have this inheritance, that required minimum distribution happening in a few years is a nuisance. I mean, it's something we can plan around for. So we're going to maximize some of these opportunities that we have to go ahead and do some Roth conversions so we can get that required minimum distribution down now that we don't need it, again, because of this inheritance. I think it's widely known. I've said it several times on this show. I have no problem telling people what I do in my own personal financial life. And I'm a huge proponent of the Roth. And so I have—
It's huge. It's a great tool.
It is a great tool.
Yeah.
So I have a 401k that's Roth. My wife does too. And then we also overfund a life insurance policy. Why am I telling you this? I'm telling you this because there is an opportunity that you're in a certain age range, you can have all of, the Roth conversion income in retirement, the income that you can derive from overfunding properly a life insurance policy. I highlighted properly there because this can be done wrong. You make sure you do it right and work with somebody that understands it. And then, so those 2 income sources, now I'm collecting Social Security, and those 2 income sources do not cause my Social Security to be taxed at all. Now, again, based on current rules, based on current law, but now we're talking about a completely tax-free retirement. Man, what a great tool to use. And again, that's more for people that are a little bit younger, maybe in your 40s, right? Even in your 50s, you can still set this up for yourself. But what a great, great tool. The Roth 401k, the Roth IRA, huge proponent doing these conversions. There you go. That was a big, long conversation about conversions.
Well, Roth conversions are important, and I know you've talked about them on the show before, Brock, but it's obviously a huge way for people to get tax-free income in retirement and let that growth grow tax-free. The earnings on that money, the compounding interest, that'll all come out tax-free, as well as your principal if you want to pass it along to your family or loved ones. That's tax-free money for them. There are so many benefits, right?
And it's not utilized as much as it could or should be, And again, I'm going to say this. There are advisors and or salespeople that will try to sell you on this concept and sell you the wrong product and structure it the wrong way.
Right.
Okay? So you have to do this right. And you have to do it right the first time because it's hard to unwind some of these things, And so, again, give us a call here. If you need help with that or you need a second opinion on what you're doing in your financial life or as it pertains to your retirement, give us a call. Innovative Financial Solutions, 573-332-7855.
Yep. And that number again, Brock, for our listeners to make sure they get it, 573-332-7855. Or go to theinnovativeteam.com.
Yes. Or check out this show on YouTube. That's right, folks. I forgot to announce that.
Yes.
It's been several weeks now, but we probably should talk about this at the beginning of every show. Thank you for listening on the KSIM. But you can always check us out on our YouTube page. Just search Innovative Financial Solutions. You'll see us on here, me and Tony, with this video camera and all this fancy stuff now. But
you can actually see what we look like, which for half of us, that's a good thing. The other half, not so much.
We're still trying to figure out which one is which.
I've never been able to properly explain myself in the video format, Brock. I can't do it. I'm a radio guy for 35 years, and then they tell me, oh, we're going to film you while you're doing your show. And I'm like, what?
Yeah. Well, sometimes it doesn't work out for people. But
Thanks, Brock.
Yep, no problem.
Yep. So what's next? What's another year-end strategy step that we should be taking?
Yeah, so we're talking specifically about taxes, right? As far as what you can do by the end of the year to help yourself with taxes. Realizing capital gains, maybe another solid year-end step to take. In many cases, the longer your stocks, have been in taxable accounts, the more your unrealized gains become. This may be an opportunity. Now, it depends what you're invested in, right? I mean, so if you're invested in, say, S&P 500 stocks, growth stocks, you've probably had some pretty good gains this year. So some offsetting that by taking some losses on some other investments that you might have. For example, and again, we still have time. We don't know what's going to happen between now and the end of the year. But as that gets closer, you might want to look at this in your portfolio to say, okay, I've got X amount of gains in my growth stocks that have been realized this year, maybe through rebalances or what have you. So is there opportunities elsewhere in my portfolio that I could take some losses to kind of offset those gains? Now, again, I'm not telling you to go do that because it may not be right to sell something in your portfolio just for taxes.
It depends on your personal situation. So you can't give out advice for all of our listeners because you need to sit down with them, look at where they're at, and then you can talk about strategies. But you're talking about, in generalities here, possibilities that they need to be considering.
Yeah, so I feel like Marco Rubio. Remember that when he was doing that that message after he took a sip of water? Sorry. Anyway, so a lot of that when we're talking about doing that is realized gains, and we're talking about capital gains. So let's kind of formulate or finalize, I guess you should say, the conversation around taxable money. Two different types of taxable accounts. So if you have an after-tax account that's just in a brokerage account that maybe some extra money that you've invested and over time, capital gains treatment is lower most of the time, taxed at a lower rate, in other words, than your ordinary income. So if you can invest in things, I just had this conversation this week with a client, Tony, actually, that he said, well, look, I've got some extra money, and we were talking about, a 5% type money market stable value kind of fund that's paying 5%. He said, okay, what else do we have? I said, well, we have a structured note investment that when it comes due, if there are gains in it, not guaranteed any gains, but if there were gains in it, it would be taxed at capital gains versus the 5% that is taxed at ordinary income. If you're in a 12% tax bracket, that doesn't really mean a whole lot to you, right? But if you're in a 22 and 24% tax bracket, that's a big deal. Paying 10 or 12 or 15% versus 22 or 24 or even higher, that could be a huge advantage. Okay, so understanding your tax buckets, right? I think most people understand like, hey, tax-free, tax-deferred, and then taxable. But within the taxable bucket, we've got to understand there are two types of taxes there. And obviously, Tony, the capital gains rate is something that is much, much more preferred than the ordinary income rates.
Yeah, obviously. And we all want to minimize that tax burden. You're right. And we all want to make sure we're in a better tax situation before the end of the year because we might want to minimize our immediate tax situation or our long term, like with the Roth IRA. So those are great points. What's next?
So the other kind of year-end thing is you want to make sure that because these limits on how much you can put in your different retirement accounts, like your Roth and your Roth 401k, have gone up every year. So are you making sure that you're maximizing the maximum amount that you can put into these accounts? For example, if you're over 50 years old and you have a 401k, have you put $30,000 in this year? Maybe you put $28,000 because you forgot to up it the last couple of years. Make sure that you're taking advantage of all these things. You still have time. You can increase your deferral for a few months here and then go back and make sure that you end up at 30,000 for next year. Actually, it's be 30,500 for next year. So it's going up again. So, that's a great point too. Like, hey, we're talking about year-end stuff here, but what about for next year? And so if you have money that you're deferring out of your paycheck, make sure that January 1 that you're going to be able to maximize so you don't have to worry and hurry at the end of the year and put more money into the year, that you're taking care of it throughout the year. Okay. And if you're interested in it, you don't know what these limits are, give us a call. Okay. And we can help you understand your situation, and then say, okay, based on what your situation is, this is what you can put in the maximum. So again, give us a call at 573-332-7855.
All right. Well, that sounds really good, Brock. And I want to encourage our listeners to get a hold of you, theinnovativeteam.com. Go there. You can check out our show page. You can subscribe to the show as a podcast or on the YouTube TV channel. Just go to YouTube and type in Alspaugh and Retirement Playbook, and it'll come up this page. You can view past shows or the current show here. Now, we're talking today about year-end tax and strategy steps, things to get done before the end of the year. What do you have for us next?
So again, I talked earlier, Tony, about required minimum distributions, right? And so some people were like, I don't know, I don't want to pay the taxes on this. So unfortunately, you have to. Okay. Now, there are some tax planning tools and investments that you can use to offset these taxes on these required minimum distributions. For example, have you looked at your charitable giving for the year? Okay. If you itemize your taxes, look at maybe giving that money. Make sure that you are, have done that at the level that you want to do it, obviously. But don't forget that can help offset some of the income and the taxes that you have to pay on that required minimum distribution. If you're someone that, like most people, you take the standard deduction because that standard deduction limit has gone so high, excuse me, talking 26,000 for a standard deduction for a married couple. Many people don't itemize anymore, Tony. But when it comes to charitable giving, you can still help yourself out with taxes. It would cost you to itemize, but it's called bunching your contributions, charitable contributions. What that means essentially, Tony, is if you have a high taxable event, say you sold a business or maybe, you sold a house, whatever it is, if you have a fairly large taxable event this year, one of the things that you could look at is bunching, say, the next 5 years of your contribution to the charitable cause. And you could put it in what we call a donor-advised fund, okay? So let's just say you give $10,000 a year to your church or to a charitable cause. You can put $50,000, so bunch those contributions for the next 5 years, put $50,000 in to help with your tax situation, because remember, you have a higher tax rate this year because you did whatever. And so that $50,000 then could potentially offset some of those taxes that you owe on that certain taxable event you had. So that's kind of a cool idea that you can get done. You still have time, okay? You still have time, but you have to get that done and set up that donor advised fund fairly quickly, okay? And if you need more information, obviously you need to talk to people like us, your accountant, maybe even your attorney. We work with all of those people to make sure that what you're doing and what we're telling you could help you do is true, and making sure that it all works together, okay? Because your money always works better together. When you have a strategy, when it comes to all of your income and your investments and then your estate planning, it all works better together.
Yep, and that's the key right there. I think you have to have a tax strategy. You have to work with a tax professional, of course, a CPA. And I know you, for your clients, work alongside tax professionals to look at the big picture, to look at things like RMDs, Roth conversions, things like that, right?
Yeah, absolutely. So again, we have the tools to show you the information, but let's get that verified. Let's understand it, and let's make sure that your accountant signs off on that and says, "Yep, what they're showing you is right," and let's go forward with it. So,
all right,
absolutely, Tony.
All right, well, that we got to wrap it up. Listeners, call 573-332-7855 or go to theinnovativeteam.com. Brock, great show. Listeners, thanks for tuning in. That does it for today's episode of the Retirement Playbook with our host, Brock Alspaugh.